Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and of course one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. And I had a Dividend Kings and a FastGraphs subscriber asked if I could cover the home building industry. The question was really relevant to the fact that on Dividend Kings we're always covering dividend stocks. But, these companies had pretty strong momentum, and she was interested in getting some growth maybe in her portfolio. I wondered if it was maybe too late. And let me explain what I mean. So I'm going to cover the big three. She asked specifically about Lennar and Pulte, and I've also put in D.H. Horton, or Dr. Horton here, into the mix as well. And Horton is BBB rated, and Lennar and Pulte are both BB+, so they're maybe just slightly below investment grade. They all have low valuations, PEs under 15, which gives them earnings yields above my 6.5% threshold, which I like that. All three pay a dividend, but they're not much in the way of dividend-paying stocks. But there's something very fascinating. So let's look at the individual stocks. And I'm going to start out by looking at adjusted operating earnings of each of these three companies. And one thing I want you to notice, as I mentioned in the written portion of this article, is just how similar the operating histories of each of these companies were. It's almost as if management didn't matter. It really mattered whether you were in this industry or not, because they're not identical results, but the results are uncannily similar. And I wanted to basically illustrate that. And I also wanted to point out some caveats as well, things that I think you should be aware of and concerned about. The first thing I want to mention, and I'm going to reiterate, you're going to see these similarities exist in every one of the home builders that I show you in this video. But I want you to see that coming, through the recession of 2001, and up through really the coming into the Great Recession, I guess you would say, of 2008, 2009, the home builders were really on fire. Their earnings were growing unbelievably fast. In the case here of D.R. Horton, they grew 10% in '01, which was a recession year. Then they grew 43%, 43%, 50%, and 50% before things started to basically crumble as the recession and the fact that the loose money that was, related or associated with the Great Recession, really started to rear its ugly head, if you will. But these stocks were tremendous growth stocks. And then during the recession, they really had some bad years, negative earnings growth. And the stocks, of course, not only plummeted from their, previous highs, they also languished here for several years. And then as we came out of the recession and things started to normalize and we entered the great bull market we've been in since the Great Recession, we started to see these companies making money again. And you'll notice they've had tremendous earnings growth. And then in March of this year, right in the throes of COVID, if you will, we had the flash crash and they all fell precipitously. Here you see D.R. Horton got down to a PE ratio of under 7, 6.69. But since that time, and this is going to be true of all three of the ones that I show in this video, the company's results have actually doubled. It grew over 109% since March 31st. The price went from $34 a share to $71.26 a share after yesterday's close. So let's move on here. Let's move on to the next one. Let's look at Lennar, and you're going to see, again, a very, very similar picture that we saw here with Horton. You see this tremendous growth, coming out of the Great Recession. Then we had this collapse. We had negative earnings growth again. And then we had strong earnings growth. And then we had really peak to trough returns here that were, in this case, 94.5% from the trough to the peak here. Now, the other thing I want to point out, and I should have pointed it out earlier, but it's, again, the same story over and over again here, is these stocks have tremendous momentum now. So in the last, 3 or 4 months here, 5 months, the companies have literally doubled in value. So they have momentum, but they also have good earnings growth, and they still have very low valuation. So I don't think it's necessarily over for them, especially as long as interest rates stay low like they've been here, going back all the way since prior to the recession of 2001. So these falling interest rates have been a support mechanism, if you will, for these home builders, notwithstanding the financial debacle that, instigated the Great Recession, which ended up being a temporary interruption. But I do want you to see that, these are very economically sensitive businesses if you look at it. So let's move on then and look at our third example, and let's look at Pulte Homes. And once again, we're going to see almost an identical picture. They're not perfectly exactly identical, but the similarities are uncanny. Very strong earnings growth, from 2001 up through about the end of 2005. Then we saw negative earnings. We saw a complete elimination of the dividend. We saw the stock languishing for several years. And then we see, this super recovery in earnings. And then once again, we see this tremendous momentum that was established since the 31st of March, which was in the height of COVID. We've had a 103% gain in Pulte during this time. But we still have undervaluation. If you look at the forecast, growth rates of these companies, they're expected to grow at 11.8%. In the case of Pulte, there are 17 analysts that are forecasting $4.34. That would be a 19% growth rate for this fiscal year, which is calendar. That would mean, we've got a 43 to 44% total return potential that just moved back to a 15 PE ratio. And going out for the next 2 or 3 years, you still have 25% rate of return potentials. Now, if I use a slightly lower multiple, if I use the normal PE of 12 instead of the 15, I still get very, very attractive numbers. I get double-digit returns going all the way out to 2022 based on these consensus analyst estimates. So, these companies do have potential still, even though their prices have rallied as strongly as they have here. So what you're looking at are 3 home builders, very similar records. It's almost as if management didn't matter in some ways, but I do want to look at some other metrics here because there are some caveats that I want to point out. Let's go ahead and look at operating cash flow. These are home builders. These are very, very tough businesses. I want you to notice that operating cash flows are very, very erratic and they rise and fall. And the same thing as a result, if you look at free cash flow, which is all about dividend coverages, and these really aren't dividend-paying stocks. They do pay a dividend. It's really, minor. The dividend yield of Pulte is only 1.06%. But you see that free cash flow goes negative as well. So, if I go back and look at Lennar's free cash flow, you're going to see, again, the similarities in these companies are really uncanny, how very erratic free cash flow generation. And again, it has to do with the nature of the beast, I believe. So I think there's an awful lot of risk in these companies. Now, I will say they're not quite investment grade rating, although Horton is. The company has 17% debt. If you look at, the debt levels of all 3 of these companies, the worst or the highest would be Lennar with 35% debt, followed by Pulte with 27% debt. And then Horton with only 17%, long-term debt to capital. So there are some caveats that I think you should be aware of from a standpoint of some risk associated with investing in these kind of companies. But having said that, they certainly have momentum now and value. So, the companies look very, very interesting, at least for the short to intermediate term time frame. Now, I want to move on and show you the 4 bonus companies that I told you I would show you in the written portion of the article. These are just some additional competitors, smaller competitors, I might add. These companies have $4 and $5 billion market caps or smaller. But again, I want you to see the very similar results that even these smaller builders have versus their bigger, what I would call more dominant New York Stock Exchange trio that I showed you earlier. Here's MI Homes. Again, it has a market cap of about $1.2 billion, but a very, very similar record. You see these, the valuations, the earnings disappeared totally. And what I'm really trying to illustrate here is this is an industry that almost every company in this industry ends up generating very, very similar results. We get the same thing with Meritage here. And then we also would get, finally we'd get the same thing with the Toll Brothers, the last company out here. And this was a little bit bigger. It has about a $4 billion market cap. These particular stocks, last 4, also have more debt. But what I really wanted you to see here was how similar all of these stocks in this home building industry really are. These big 3, have the largest market caps, $25 billion for Horton, 22.3, almost 22.9, almost 23 billion for Lennar, and 11.8 or almost 12 billion for Pulte, in contrast to the other 3 that I showed you here that have much smaller market caps. I haven't loaded them on here. I'll go ahead and load them for you just so you can see that real quickly using the portfolio review function. We got 3 billion, 1 billion, 3.7 billion, and 4.9 billion. But regardless, I hope you got something out of this. These companies all operate very similarly in this home building industry. They're all definitely being supported by low interest rates today. These companies struggle with generating consistent cash flow. They have very little free cash flow. from time, and it goes negative oftentimes. So there's a lot of risk with owning them. But right now, these stocks do have momentum. Most of them are reasonably valued. So if you're interested in something that might give you, some short to intermediate term capital appreciation, you might want to take a look at it. We've missed a big part of this, obviously, but I think there's still some juice left in these guys. Anyway, this has been Chuck Carnevale saying thanks for watching. I hope you enjoyed this video on the home building industry. Thanks for watching. And if you like what you see here, you might want to take a look at our Dividend Kings marketplace service where we cover more blue chip dividend growth stocks. But this was a subscriber request from the Dividend Kings that was looking more for some recommendations on some growth opportunities. Again, thanks for watching.